Hey, everybody, it's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. I'm a certified mortgage advisor, and I've been helping families navigate the mortgage markets for more than 20 years. And every Monday, I take the complexities of the biggest mortgage and housing news, and I break them down in a way that's much easier to understand so that you can make smarter decisions about buying, refinancing, or investing in real estate. Now, the rest of the week, my team and I work with multiple investors to deliver the best loan products and pricing for each client's personal situation. Because your home financing should never be a cookie cutter, one size fits all experience. Now, 1 Minute Monday has three sections. First, for those who just want to know what time it is. Second, for those that like to understand how the clock works a little bit better. And third, for my fellow clock builders, where we zoom out and we talk about the bigger forces that are driving mortgage rates. Now, let's go ahead and start with what time it is. Inflation continues to cool, with core CPI now at its lowest level in nearly 5 years. Now, core CPI, it's a measure of inflation that removes food and energy prices so that economists can see the underlying inflation trend. Now, shelter costs, which make up a large portion of inflation, they also showed improvement, with rents rising just 0.1% last month. That's the smallest increase in over 5 years. Now, shelter costs include rent and housing expenses, and they make up the largest portion of the government's inflation calculation. Existing home sales, they ticked higher in February, showing that buyers are slowly returning to the market as affordability starts to improve. Housing starts also jumped, but the increase came entirely from multifamily construction, while single family permits, they actually declined. Now, housing starts measure how many new homes builders began construction on, and that helps predict how much future housing supply may be coming. Now, meanwhile, the broader economy slowed more than expected. Fourth quarter GDP was revised down to 0.7% growth, and that's a sharp drop from the 4.3% growth that we saw the quarter before. Now, here's what markets are actually doing this morning. Mortgage bonds are actually rebounding pretty strongly. They're up more than 30 basis points, while the 10-year treasury yield it's down about 5 basis points. Now, a big reason for that improvement is that oil prices are pulling back from over $100 a barrel to around $94, which is easing inflation concerns. And according to Mortgage News Daily, national average mortgage rates, they're currently around 6.36 for the 30-year fixed rate, 5.95 for the 15-year fixed rate. The 30-year FHA is 5.87 and the 30-year VA is 5.89. Now, remember everybody, these are national average rates reported by Mortgage News Daily. Your personal rate, it could be higher or lower depending on factors like whether or not you're paying discount points, what type of loan you have, your credit score or debt ratio, your down payment, and the overall loan structure. So, for now, we're going to go ahead and begin this week floating. But I do want to mention that we had three alerts to lock last week, which tells us just how volatile this market's been. So, hey, if you're in contract closing soon, timing does still matter. All right, that's what time it is. Now, let's go ahead and talk about how the clock works. The big driver behind mortgage rates right now is kind of a balance between inflation and economic growth. Inflation data last week actually came in fairly encouraging. Core CPI, it's actually now running at 2.5% annually, and that's the lowest level since March of 2021. Shelter inflation, which accounts for nearly half of that core CPI, it also slowed pretty meaningfully. But the Fed's preferred inflation gauge is PCE, and that still shows core inflation around 3.1%. And that means that inflation's improving, but not quite as fast or not fast enough for the Federal Reserve to actually start cutting rates aggressively. Now, at the same time, the economy is clearly losing momentum. GDP was revised down to 0.7%, and while jobless claims remain low, the labor market's gradually cooling off. And this week, we actually have a major event for markets, the Federal Reserve meeting. And the Fed's widely expected to leave the Fed funds rate completely unchanged, but markets, they're going to be paying really close attention to something called the dot plot. Now, the dot plot is basically the Fed's forecast for where they believe that interest rates are going to go in the future. And the latest projections suggest roughly 2 to 3 potential rate cuts later this year, but that's really depending on how inflation and the labor market evolve. Right now, there's over a 90% chance that rates are going to remain unchanged at this next meeting. So investors are going to be watching really closely to see whether those expectations remain or if persistent inflation pushes those cuts further into the future. And then there's another factor influencing mortgage rates right now, which is oil prices. Now, oil recently climbed close to that $100 per barrel, and that was mainly due to tensions involving Iran and the broader Middle East developments. A higher energy cost, they ripple through the entire economy. We end up with increased transportation cost, manufacturing cost, and that then gets pushed into consumer prices. And that's why when oil spikes, bond prices tend to react pretty quickly. But this morning, oil pulled back to around $94, which is really helping mortgage bonds recover. Now, from a technical standpoint, mortgage bonds tested their 200-day moving average last week, and that's a level that they haven't really broken through meaningfully since about 2025. Now, today we're seeing a rebound off that support level. If bonds hold those gains throughout the day, the 3-day candlestick pattern could form what's called a morning star reversal pattern, and that often signals improving bond prices. Now, there's also roughly 60 basis points of room for mortgage bonds to improve before they hit the next resistance level. Now, meanwhile, the 10-year treasury yield, it's actually moving lower and it's got room to fall towards the 4.2% level, which is also its 200-day moving average support level. So technically speaking, the bond market, it's still sitting at a very important decision point. All right, that's how the clock works. Now, let's go ahead and talk about how to build the clock. When we zoom out, mortgage rates right now are sitting at the intersection of Washington policy, global energy markets, and a slowing U.S. economy. Now, mortgage rates are currently being influenced by three major forces, and that's inflation trends, economic growth, and the labor market, and global energy prices. Now, oil is one of the fastest ways that geopolitical events influence mortgage rates. When oil prices rise quickly, markets worry that energy costs are going to push inflation much higher again. And when inflation expectations rise, bond yields typically rise as well, and that pushes mortgage rates higher. Now, here's where the current situation matters. If the conflict in the Middle East de escalates quickly, say within the next month, oil prices could fall further, which would remove some of the inflation pressure from the market. And that scenario would likely be supportive for mortgage bonds and potentially help mortgage rates improve. But if the conflict actually becomes longer and more involved, energy markets, well, they would remain volatile or push oil prices even higher again. And sustained higher energy prices tend to keep inflation expectations elevated, which would actually make it hard for mortgage rates to move any lower. Now, this is a really good reminder for anybody who already benefits from refinancing at today's rates but's considering waiting for lower rates. There's a lot of homeowners who wanted to refinance before the recent geopolitical headlines hit, but now they've seen rates move about a 0.5% higher, which means that many of them, well, they're probably not going to see another opportunity for a long time. And had they pulled that trigger before the volatility, they'd already be saving meaningful money every single month. Now, look, nobody's got a crystal ball that I know of, at least not one that actually works. That's why one of the best strategies is for us to have a conversation so that we can set a refinance strike rate or what I would call a trigger point ahead of time. When the market hits that level, you act. Because in mortgage markets, some of the best opportunities only exist for a few days, sometimes even less. So having a strategy in place, it removes the guesswork and it helps make sure that we don't miss those windows when they appear. From there, patience still remains to be the strategy. Now, if you're thinking about buying, refinancing, or just trying to understand this strategy and this market, my team and I, we're always here to help. We're never going to pressure you to do something before you're ready. We just want to make sure that we're there for you the way you need us whenever you are. And remember, through the Home Foundation, we're always looking for ways to make homeownership more affordable for our local heroes in the military, law enforcement, and fire protection services, as well as shed light on some of the amazing charities that support them. So scan the QR code on the screen or click the link in the description if you'd like to help, or if you know that there's a local charity that supports our heroes that I should be talking to. I'd love to meet them and I'd love to help spread the word. Until next week, stay safe and be good to each other.